Why stock prices matter. When it comes to investing, the price of a stock is not just a number you see on a screen. It's a reflection of the value that the market places on a company at any given moment. Understanding why stock prices move the way they do is crucial for anyone looking to get involved in the world of finance, whether you're just starting or have years of experience. At the most basic level, stock prices represent the price at which shares of a company are bought and sold on the stock market. But why do these prices change? And what do they really mean? The simple answer is that stock prices are driven by supply and demand, the same forces that affect prices in any marketplace. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price falls. However, the story doesn't stop there. Stock prices are not only influenced by the current market sentiment, but also by the future expectations of a company's performance. Take, for example, a tech giant like Apple. Apple's stock price doesn't just reflect how well the company is performing today, it also reflects investors' expectations for future growth. If Apple is expected to release a groundbreaking new product or report higher than expected earnings, the stock price might surge, even before those events actually happen. This is called price anticipation, and it's one of the most fascinating aspects of the stock market. Let's look at a real-life example: Tesla. In recent years, Tesla's stock price has skyrocketed even though the company has faced production challenges and is still working to become profitable on a consistent basis. Why? Investors believe in Tesla's future growth potential, especially with CEO Elon Musk's leadership and the company's ambitious plans for the electric vehicle market. The anticipation of future success drove the stock price higher, despite the hurdles Tesla faced along the way. On the other hand, companies that miss earnings targets or experience a public crisis can see their stock prices fall dramatically. Consider the case of Facebook, now Meta. When Facebook faced a series of privacy scandals and regulatory concerns, its stock price took a hit. Even though the company continued to generate substantial revenue, investors were concerned about its long-term future and the risks that could hinder its growth. In this case, the stock price reflected investor fear and uncertainty about the company's future rather than its present performance. The impact of stock prices isn't just limited to the companies involved. Stock prices also have ripple effects across the broader economy. When stock prices rise, it can boost consumer confidence and spending, leading to a thriving economy. On the flip side, when stock prices fall, it can lead to reduced confidence and less spending, contributing to a slowdown. This is why financial analysts and economists closely monitor stock prices. They can be an early indicator of shifts in the overall economy. But for individual investors, understanding stock prices isn't just about watching numbers go up or down. It's about identifying trends and using those insights to make informed decisions. Knowing why stock prices fluctuate and what drives those fluctuations can help you predict how certain stocks will perform in the future, allowing you to make smarter investment choices. What drives stock prices? Stock prices don't just fluctuate randomly. They're influenced by a variety of factors that investors and traders keep a close eye on. The most important of these are earnings reports, economic conditions, market sentiment, and company news. For example, when a company like Apple releases its quarterly earnings, the market reacts based on whether those earnings beat or miss expectations. If Apple's earnings exceed projections, you might see a rise in stock price because investors see it as a sign of growth and profitability. On the flip side, if the earnings report is disappointing, the stock could take a hit. But it's not just about the company's performance. Macroeconomic factors like interest rates, inflation, and global trade tensions also play a huge role. Take the U.S.-China trade war. When tensions rise, stock prices of companies that rely on international supply chains, like tech giants, can drop due to concerns over tariffs and market access. Lastly, market sentiment, the general mood of investors, also has a huge impact. During periods of economic uncertainty, such as the early days of the COVID-19 pandemic, stocks can become volatile as investors fear for the future and react to news cycles. In contrast, when optimism is high, such as during the post-pandemic recovery, stock prices may surge as investors are more willing to take risks. In short, stock prices are driven by a mix of company performance, economic conditions, and investor sentiment, all of which constantly shift based on both internal and external factors. Keeping track of these elements is crucial for understanding why stocks move the way they do. Valuation metrics you need to know. When it comes to evaluating stock prices, There are several important metrics that investors look at to determine whether a stock is undervalued or overvalued. Let's break down some of the most important ones. A really important metric to focus on is the discounted cash flow model, or DCF. This one is critical because it focuses on the company's future cash flow, how much money the company will make in the future, and how that will be worth today. The idea is simple: the money you earn in the future is worth less than the money you have today. So the discounted cash flow model helps you understand the value of a company based on its future earnings potential, adjusted for that time value of money. It's a more in-depth look at a company's financial health and can give you a clearer picture of what a stock is really worth. One of the most common metrics is the price-to-earnings ratio, or price-to-earnings ratio. This tells you how much investors are willing to pay for each dollar of a company's earnings. If a company has a high price-to-earnings ratio, it might mean investors are expecting high growth in the future. But if the price-to-earnings ratio is low, it could signal that the company is undervalued, or that there's little expectation for future growth. Another key metric is the price-to-sales ratio. This one looks at how much investors are willing to pay for each dollar of revenue a company generates. A low price-to-sales ratio could indicate that a company's stock is a good value relative to its revenue, but this is something you need to consider in context. A company in a high-growth industry might have a higher price-to-sales ratio because investors believe the company will grow significantly over time. Lastly, we have dividend yield, which shows how much income an investor can expect from dividends relative to the stock price. If a company pays a $2 dividend and its stock costs $40, the dividend yield is 5%. This metric can be especially attractive to investors seeking regular income. These metrics, together, can help investors get a sense of the stock's true value. But remember, no single metric tells the whole story. You need to look at the bigger picture, considering multiple factors before making a decision on a stock and the future of stock price evaluation. As we look to the future, stock price evaluation is evolving rapidly with the rise of artificial intelligence. Investors no longer rely solely on traditional metrics like price-to-earnings ratios or market sentiment. Instead, AI and machine learning models are becoming powerful tools to predict stock trends and evaluate company performance. AI models can analyze vast amounts of data, including historical price movements, news sentiment, social media discussions, and even real-time financial reports. For example, platforms like AlphaZense and Dataminer use AI to scan financial documents and news in real time, offering investors insights that were once difficult to obtain quickly. Machine learning models are also helping investors predict stock movements with more precision. One example is how hedge funds are using AI algorithms to model market behaviors, adjusting their strategies based on predictive analytics. In 2020, for instance, Renaissance Technologies, a leading hedge fund, used AI to drive much of their success during volatile market periods. Moreover, AI tools can crunch data faster than human analysts, making it possible to detect trends and anomalies in the market before they become apparent to the average investor. This allows for quicker decision-making and potentially higher returns. Looking forward, the role of artificial intelligence in stock price evaluation will only grow. While traditional methods like price-to-earnings will remain relevant, AI will increasingly shape the way we understand stock market movements, providing a more data-driven and automated approach to investment. As these tools become more accessible, both individual and institutional investors can benefit from smarter, faster, and more accurate evaluations of stock prices. The power of market forces: supply, demand, and investor behavior. First, let's break down supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people are selling than buying, the price falls. This dynamic is driven by factors like company performance, news, and overall market sentiment. But stock prices don't just follow fundamental factors. There's also technical analysis, which looks at past price movements to predict short-term trends. For example, chart patterns or moving averages can provide clues about whether a stock is about to go up or down. This approach is especially useful for traders looking to capitalize on short-term price fluctuations. Another important aspect is behavioral finance. This examines how emotions and psychological factors influence investor decisions. For instance, the herd mentality can cause a stock to skyrocket when everyone jumps in at once, or plummet when fear takes over. A well-known example of this is the GameStop phenomenon, where social media-driven excitement led to an extreme spike in price, despite the company's fundamentals not justifying it. By understanding these forces, supply and demand, technical analysis, and investor behavior, you get a fuller picture of how stock prices move. And that's the end of today's video. Thank you for watching, and I hope you enjoyed it. Please click the like button, subscribe to the channel, and hit the bell icon to enable notifications so you never miss a new video. Your support means a lot, and I look forward to sharing more content with you soon. See you next time.